That is the headline that dominates the news across the globe. Crude prices crashing as OPEC countries decide not to cut oil production. Brent crude has now tumbled more than 5% to $73 a barrel, whereas the WTI contract is currently trading below 70 at $68 a barrel. That's an 8% cut on the WTI contract. Markets in Europe mostly higher. The British FTSE flat, the German DAX up about 0.5%, whereas peripheral markets are also in the green. The Italian MIB and the Spanish IBEX ending close to 1% higher. The euro slightly lower at 124 levels on general strength in the dollar. A mixed picture in Asia this morning. The Japanese Nikkei down 0.8%. The yen staying close to that 118 level. China's Shanghai Composite up 1%, whereas the Hang Seng in Hong Kong ended 0.5% lower. The South Korean Kospi ended the day flat. All right, let's get to that top story this evening. It's a rout in the oil market, a big collapse in prices as OPEC countries decide not to cut oil production targets at today's meeting in Vienna. Brent crude, as I just pointed out, is down nearly 6% at just about $73 a barrel. The WTI contract has dropped all the way down to $68 a barrel. That's a 7 to 8% cut on the WTI contract. Now, OPEC's current production target is 30 million barrels per day. Reports suggested that Saudi Arabia would call for a cut of up to 1.5 million barrels a day to help put a floor to prices. But that was before the OPEC meeting took place. Right after the OPEC meeting, we had the decision coming in that there will be no cut in prices. Here's what the Iranian and Nigerian oil ministers had to say right after that meeting.
Market, we have oversupply in the market. It's no doubt that we have oversupply in the market, but how to manage it? It seems that we need time, more time to see the reaction of the market against the lower price that we have in the market, and more consultation between OPEC member. And it's no doubt that OPEC has a unity and solidarity to manage the market at the convenient time.
And of course, we are hoping that over the next year, we will see a lot more stability in terms of the market coming into fall.
Tell me how the decision went. So we have a rollover, but we don't have an extraordinary meeting in the spring. There must have been a push for an extraordinary meeting.
Well, given the circumstances, there were some calls for that, but we felt that at this point in time, the rollover should be sufficient to ensure that the decline in prices is kept to a minimum or erased altogether. And we would hope that it doesn't come to an extraordinary meeting. But of course, if and when that's necessary, we are always ready to call one in.
The market's going to test OPEC, it's going to test the producers. Right. Is there a price trigger at which an extraordinary meeting will be called? Do you think $70 is a challenge for OPEC?
I think $70 is a challenge for most oil-producing countries, not just OPEC. And of course, we are oil-producing countries, so we would hope that it wouldn't get to that point.
All right, that was CNBC's Steve Sedgwick interviewing the Iranian and Nigerian oil ministers. And here's Steve with a comprehensive wrap of what went on in that meeting that took place in Vienna just a short while ago.
As we draw to a close on a momentous day for OPEC and indeed the oil price, it appears that OPEC has decided to confront the market and try and retain market share rather than worrying about price. After a rollover in which the group of producers said they would maintain production at 30 million barrels a day in the first half of 2015, the oil price reaction was immediate and tested recent downside limits as well. The Secretary General said that they were not sending a signal to anyone. They were not rushing to do anything and did not want to panic, but the decline in price did not reflect fundamentals. Other OPEC members, though, have been telling CNBC that actually there is an oversupply in the market. In fact, the Iranians told CNBC that the oversupply would get worse in 2015. There was some dissension in the ranks, and Rafael Ramirez, who is the Venezuelan foreign minister and representative at OPEC, was very tight-lipped as he left the meeting. He had been lobbying quite hard, we understand, for some form of reaction to the recent price cuts from the cartel, but did not get a cut in production this time round. Steve Sedgwick for CNBC in Vienna.
All right, let's get your expert opinion. Richard Mallinson, geopolitical analyst at Energy Aspects, joins us with his take on the OPEC decision and the big fall in prices that we've seen currently. Richard, good afternoon to you. Thank you very much for speaking with us. We've seen a 6 to 8% crack in crude oil prices, whether on the Brent contract or the WTI contract, in response to this OPEC non-decision. How much further lower can prices go?
Well, I think there's potential for prices to continue falling through today and tomorrow. We might even see Brent prices falling below $70 a barrel, which would be a pretty big psychological threshold. What's really happening is that the market is focused on the picture for 2015, the supply-demand balance, and it's looking certainly at the first half of that year, and without an OPEC cut, the first half of that year does look very oversupplied. That's a period when seasonally demand is weakest. In the second quarter of the year, we have a lot of refineries offline for maintenance. We don't have a lot of demand either for heating in the colder countries during winter or for air conditioning in hot countries, say in the Middle East during the summer. And so that means demand was always going to be weak. But you add in strong non-OPEC supplies, so US tight oil and other areas, and also you add in OPEC continuing to produce at 30 million barrels a day, or maybe even continuing to exceed that target, and you do look at a market that's going to have too much oil, that's going to be building up stocks, and that's really what's driving this very dramatic response in prices today. And it's also going to be enough, I think, to keep prices low, probably in the 70s, into next year, until or unless we see some kind of action from OPEC. I think there's a good chance if prices do continue to fall and then stay low, OPEC will call an extraordinary meeting. We heard some of the comments that they haven't signed up to that yet, but I think with the Nigerian oil minister saying that they certainly wouldn't rule that out, and I think we might well see that not too far into 2015 if we have a few more months of low prices, because those prices really are hurting many of the OPEC producers' budgets.
You mentioned, Richard, that we could expect the Brent price to fall below $70 a barrel later today or even in trade tomorrow. Do you expect it to sustain at below $70 a barrel prices right through, let's say, the first quarter of the next calendar year as well?
It's a very good question. I think I would say there's potential for it to fall below 70. This is a day when the US markets are closed for Thanksgiving, so actually the volumes of trade are quite small, and that means you can have bigger price movements. But in terms of fundamentals, both now in the next month or two and even into 2015, I think prices are more likely to be above that $70 threshold. It's just that I think there's a good chance we test it or even we dip below it briefly.
Okay, I do want to talk about what reasons that could have driven this OPEC decision. Is it based on fundamentals, demand-supply situations? Is it based on the fact that we're seeing very weak growth scenarios in Europe, in Japan, in China, relatively speaking in China, I might add? Or is it based on geopolitics? Is this a market share game? Is this an effort to bring the US shale industry to its knees, or to hurt Russia's economy, or even to bring Iran to the negotiating table?
Well, I think there have been lots of different theories put out there, and in a sense that's probably because it's been a bit of a vacuum in terms of the internal thinking of the key players within OPEC, most notably Saudi Arabia. But my take is that this isn't a direct response to fundamentals. Even OPEC's own analysts in the OPEC Secretariat point towards a weak demand and demand below 30 million barrels a day for OPEC crude next year. So just looking at their own numbers, there would have been justification to cut back. I also don't really give much credence to some of the suggestions about Russia or targeting Iran or targeting US shale. I think what we're really seeing is the dynamics within OPEC as a group, some of the challenges there, and in particular Saudi Arabia and its near neighbours in the GCC. They didn't want to bear all of the responsibility for cutting alone, whilst other countries like Nigeria, Iraq, Iran, Libya, Venezuela perhaps continue to pump at their absolute maximum. That isn't really, in the view of Saudi Arabia and others, how OPEC should work and how OPEC needs to work going forward. They didn't want to set a precedent by cutting unilaterally without all members participating and supporting a cut, and so instead they took a tough line. I think that the people who opposed to cut in the meeting will have known that a price fall was coming and will have known that prices are going to be lower as a result into 2015, but I think for them the discipline and the cohesion within OPEC is a longer term question, and that outweighed the need to get to a cut during this meeting.
So what you're saying, Richard, is this is not as much a market share fight between OPEC producers and non-OPEC producers, but more a market share fight within OPEC producers themselves.
I think that puts it really well. In fact, long before prices started falling, we had the signs of tensions over market share, in particular in the Asian markets, which are the big growth markets in recent years, we had Saudi Arabia, Iraq and Iran setting their official selling prices, which are the sort of list prices for buyers. Each month, Saudi Arabia would come out with a price, Iraq and Iran would undercut it by $1 or $2 in what seemed like an attempt to woo away buyers to find those extra places to place additional output. And I think that built us up to the situation that we've seen in the meeting, or at least contributed to the situation we've seen in the meetings in Vienna this week, the difficulties that OPEC has found, now prices are falling, now fundamentals have weakened, to respond cohesively. I think these are forces that have been building for some time, and they're probably ones that will take several meetings for the group to resolve, for them to come back together and for them to decide how to respond to collectively.
So can you draw for us, Richard, a supply picture for 2015, at least the first half, before any kind of extraordinary OPEC meeting takes place? Will OPEC production, which currently I think exceeds the ceiling by about 1 million barrels per day, so it's coming in closer to 31 million barrels per day as opposed to the production ceiling of 30 million barrels per day, how will that compare with non-OPEC supply, and what will the actual demand be? Therefore, what will the surplus or oversupply be estimated in the first 3 to 6 months of 2015?
Okay, so if we start with OPEC supply, you're absolutely right. It's been running at above 30 million barrels a day, over the quota that was rolled over today for several months. I think, in fact, this month and into December, that's likely to drop. We see seasonally Saudi Arabia reduces its production around this time because it's using less in its own domestic power sector. And for air conditioning and cooling, now we're out of the summer. We've also seen some setbacks and disruptions in Libya. So OPEC's numbers and production are likely to go down in the very short term to below 30, or at least around 30. But that shouldn't be taken as a signal that they're choosing to cut despite the announcement. I think through and into next year, they're likely to stay somewhere around 30 million barrels a day. They'll certainly try to be more disciplined at that number. But when we think about non-OPEC supply, we're seeing strong growth from the US shale sector. We're seeing growth from countries like Brazil with its pre-salt. We're seeing flat production or growth in a few other areas. And so overall, the non-OPEC supply are going to continue rising on average by over 1 million barrels a day next year. Certainly in the first half, before maybe a slowdown because of the prices starts to appear in the second half. You add those up and you compare them to, as I mentioned earlier, the weakest period of the year for demand seasonally in the second quarter of the year, with lots of refineries offline for maintenance, a much lower need for crude. And I think we'll see small crude stock builds in the first quarter of the year, maybe 300,000 barrels a day, and potentially very significant, well over 1 million barrels a day of stock builds in the second quarter of the year. And that's really what's weighing on prices now and will continue to weigh on prices unless OPEC changes its mind, comes back together and takes some action before we get into that second quarter, which is where the weakness looks heaviest.
All right, so we've got a weak demand situation persisting through the better part of next year. We've got a stronger dollar situation that could continue through the course of next year. You've given us a sense of where you expect prices to be in the near term. What's your medium-term and long-term call that's over the next 12 to 15 months for crude prices?
So I think once we get out, I think the first half of next year will be the lowest prices, presuming that we see some kind of pickup in demand, which we're seeing the very early signs of, and you would expect with this much of a fall in prices, you start to stimulate better demand growth. You also start to take some non-OPEC supply growth out of the picture for late 2015 and certainly 2016. I think we see prices recovering late next year towards $90, $95 a barrel, and then into 2016 and beyond, the long-term fundamentals start to reassert themselves. And the reality is that for the market to remain well supplied, it needs very high-cost production. That might be deep water offshore production, Canadian oil sand, even the US shale itself. All of these are very costly. They only really make economic sense with prices at $90 plus, even at $100 plus. So I think we revert towards those prices for the long term. The issue comes, the more dramatic the price fall now, potentially the more of a rebound we're storing up for 2016, 2017, as projects that were going to come online and add supplies get cancelled, and as demand growth really ramps up and accelerates. Those two factors could come back and mean that the market looks a lot tighter further out.
All right, so it's maybe at the most a year or 15 months of a honeymoon period, especially for emerging markets like India that depend on imported energy. Crude oil prices are probably going to remain low for just about that period. Thank you. That's a fair warning, Richard, and thanks very much for joining us this evening